Hey everyone, Eric here. In this video, I'm going to explain to you how to prepare your startup for when it looks like we're going into a recession or an economic downturn. By the end of this video, you will have a great understanding of what you need to do to navigate these conditions. Okay, let's get started. So I'm going to talk about 7 actions to take to prepare your business for heading into a tough environment. So one thing I briefly want to say is the opportunity cost. So a lot of people say, I don't know, this stuff sounds kind of extreme. But I want to let you know that if you act too slowly going into a hard environment, your business can go out of business really, really quickly. And so if you act too slowly, you can die. But if you react quickly and the environment is not as bad as you expect or improves more quickly than you expect, you just end up with a leaner business. So it's better to act quickly going into a sort of bad looking environment. So a quick update, it's May 2022. There's been a capital markets correction for technology companies, and it's happening really, really fast. Just like over the last couple weeks, it started accelerating. It's easy to be in denial in a moment like this because it's happening so quickly, or resist the new reality and say, oh, well, it's just going to go back to how it was. No, I would encourage everyone to act quickly, aggressively, accept this as the new normal, and plan your business based on these conditions. Because usually there isn't a quick return to a previous paradigm. So just try to, get your psychology in order so that you can respond accordingly. The last time we did this exercise, by the way, was 2020 when COVID hit, just 2 years ago. That downturn on the capital market side in the consumer for technology businesses bounced back really, really quickly. But we prepared for the worst and we got an outcome that was better. So sometimes it looks like you're going into a recession and the recession doesn't happen, or it looks like you're going into a bad one and ends up better than you expect. But you want to be ready for the worst, and then if it's better than you expect, then that's not an issue. So today, here are the 7 topics that we're going to cover. We're going to talk about unit economics. We're going to talk about slowing down your growth rate and customer acquisition. We're going to talk about how to really think about your burn and runway calculations in an environment like this. Layoffs, which are called reductions in force, repricing employee stock options to make sure they're properly incentivized, cutting other expenses, and then working with your investors and partnering with them to get through these conditions. So I just want to give you a quick update. It's May 2022 on what we know up to this point and on what we don't know. So looks like we're heading into some sort of a down market. And so here's the information we have today. Public valuations for the comparable companies for startups. So these are like software businesses and technology, high growth technology businesses. Public valuations have collapsed between 50 and 90% for pretty much all growth companies. This is driven by rising interest rates, a big jump in inflation. And so what this basically means is that the exit values, so if your startup is going to go public, that's your exit, have been absolutely destroyed. And so that reverberates through the whole ecosystem. So late stage seems to be at the epicenter so far. So that's sort of like Series B plus, because those businesses are closer to their IPOs. So you can't pay a really high valuation if it's going to IPO at a low valuation. But it's trickling through sort of all of the different stages of startups right now. So fundraising has just very suddenly become much harder at any valuation. And a lot of people say, well, isn't the dry powder high? And dry powder means that all of these big funds have raised new funds, multi-billion-dollar funds. They said, if there's all these billions sitting around, why can't we raise money? Well, the thing is, when a venture capital fund raises a fund, it's basically just a commitment from their limited partners, who are the investors of the fund. The limited partners don't send them the money. So it's not like it's sitting in a bank account. Every time they need to make an investment, they basically call their LPs and they do something that's called calling capital, which means, hey, can you send me $100 million? I'm going to invest in this late stage startup. Nobody wants to call their LPs and call capital right now because the market is so crazy. So yes, they have this committed capital, but it's not like they can really deploy it at the moment. So other things that we know right now is that over the last 12 months, advertising costs, especially on Facebook, have been absolutely skyrocketing because of the iOS 14 thing, the update from the Apple operating system that limited Facebook's ability to track users. It's made advertising much more expensive. We know that B2C consumers are spending a little bit less online in 2022 versus 2021. So that's something that was happening before this. And so far, This is much more of a capital markets issue than an economic issue. So to the extent that a business depends on fundraising for its survival, then this is a huge issue. But if a business is break even or better, then the consumer still seems to be doing pretty strong. But usually if there's a huge capital markets issue, it can kind of flow over to the consumer side and vice versa. So we're still sort of waiting to see what is a consumer going to do. So here's what we don't know yet. Duration. Like I said, this could be a head fake, or this thing could be multiple years. If inflation is really high and they need to keep rates up and the stock market continues to do poorly, the consumer stops spending. We don't really know all of this stuff, so we don't know the duration. So we should prepare for a longer duration event, 1, 2, 3 years, and then we just have to see what happens. So where the damage will play out in the economy, where's the most demand risk? So it depends who is your end customer. We don't totally know, like there hasn't been a huge drop off in demand yet, so we're still waiting to see where that'll happen. So how much will demand be impacted for B2C, so like direct to consumer businesses versus B2B? Again, unclear. One thing to keep your eye on is that in down markets, talent a lot of times can be easier to hire, so that's sometimes a positive. And then the cost of advertising may end up dropping just because so much of the ad spend is funded by venture. And so if these late stage businesses can't raise these huge venture rounds, well, then a lot of their ad spend is probably going to evaporate. So it's good to have cash right now so that if we see any of these opportunities pop up, that we can react. So the high level plan is basically to optimize your business for cash flow instead of growth. So don't depend on the fundraising to grow. Instead, control your own destiny. And that's basically the high level plan. And I'm going to walk through these 7 steps of how you can do that. So the first thing is to tighten up your unit economics. So what you need to basically do, and I'm going to walk through an example of how you would do this with like a B2B company and a B2C company right now, but you need to do a really deep dive on your post-marketing unit economics. So obviously the first order and your sort of customer lifetime to understand your payback dynamics and so what you need to do next. So let's kind of walk through 2 different types of businesses, and we'll chat through sort of how you should be doing this analysis and then how you should be thinking about what you can change at this moment. So first off this is a B2B SaaS startup. So a business that the customers pay a subscription, they have a very long customer lifetime, but the customer acquisition cost is probably very high. So let's say the first order, so the monthly subscription cost is $3.99. But in this situation, the customer lifetime, we're saying is 29 months on average. And so this is the lifetime revenue. So let's just look at the first order of a customer lifetime. So the customer pays $3.99. Then we have customer service, software, and hosting. So these are the 3 elements of their cost of sales. And so the gross profit on that first month is $291 at a 73% gross profit margin. Let's say CAC for this business is $3,500. So you need to basically pay that up front, even though your customer in the first month is only going to make about $300 of gross profit. And that the payback period is around 14 months. So that means that a customer needs to be in the business for about 14 months to generate enough gross profit to pay back the CAC. So after 14 months, then your customer is basically profitable for the company, but through those first 14 months, you're effectively just recouping your marketing costs. So when you acquire any single customer, you lose $3,200. So in a strong fundraising environment, you can raise money to fund this type of customer acquisition. But if the fundraising dries up, this all of a sudden becomes a much more precarious situation. So the lifetime of this customer, if we kind of move through this, is $8,400 of lifetime gross profit. So this is called your customer lifetime value. And so, by month 29, you will have basically, made $8,400. In the first month, you basically paid $3,200. But by month 29, your post-marketing margin is about $5,000. The issue is that you lost a bunch of money for the first year. And so this is the thing that we want to tweak right now. So first thing is that you want to consider your pricing. So if you raise your pricing by 2x, how many of your customers would drop? So with B2B companies, this is a really important question. Like if you could double your pricing and you lost a quarter of your customers, that would be worth it. And so you need to really figure out how can you get to break even or how can you burn less cash. And so that's a question you should ask yourself. Optimize, cut costs. So negotiate with vendors, look for alternatives, run as lean as possible. So go through your COGS, figure out what you can cut, figure out what you don't need, figure out if you're not going to grow as quickly, how big of a customer service team do you need? You need to try to figure out how to get your gross profit as high as possible. Because ultimately, at the end of the day, you're trying to increase your post-marketing um, your post-marketing gross margin. So this number, you can't be burning $3,200 every time you acquire a customer. So you need to figure out how to get this number lower. And the last thing is you need to focus on lower CACs. So focus on your organic channels, focus on the cheaper paid channels, just the lowest hanging fruit. We're going to talk about this in a sec, but probably you want to slow your growth down and just focus on customer acquisition if it's cheap, and if it's expensive for now, do not focus on those channels. So if you're a D2C e-commerce startup, you're going to have a very different customer. So we're saying that our customer lifetime in this situation is basically 2.1 lifetime purchases, whereas a SaaS company could be, 29 purchases. So these businesses have very different payback dynamics. So let's say your first order is $115. You have your product, fulfillment, and customer service. Of course, you're going to want to go through every single one of these categories, figure out what you can do on the product side, the fulfillment side. Can you open up another warehouse? Can you renegotiate with the shipping company? All of this different stuff. Do you need the customer service team to be as big? Can you hire in a different geography? So do everything you can to increase your gross profit margin. And let's say your CAC is $80. So when you acquire a customer in this business, you actually only lose $6. So the customer acquisition payback isn't as precarious as sort of a B2B company. So you don't really burn money when you acquire a new customer. So to the extent that your CAC was higher than 80 and you needed to basically burn a lot more, you'd have to kind of focus more on the lower CACs and lower growth. But a business like this can kind of keep steady and continue to acquire customers as long as they're not burning a lot of money on the sort of first order. So the customer lifetime in this case would be about 2 lifetime orders. This is the customer lifetime value, which is the lifetime gross profit, $155. And so for a business like this, once they acquire a customer, their payback period we're saying is within about 3 months. So kind of once they cross that, you get into this profit zone, and that you actually make about $75 of profit on each customer. So a business like this should actually continue to acquire customers if they can maintain these CACs aggressively, because they're actually going to be making more profit on more customers. So really depends on your business model. All of the same things would apply. Can you look at your pricing? What can you do on the cost side? Potentially you should be focusing on the cheaper channels, the organic channels, more email, less growth, and just try to optimize your margins right now. So a lot of focus should be on your gross profit margins. So the second action I recommend you take is slowing your growth down if you're burning cash. So the easiest way to do this is slowing down your customer acquisition. So customer acquisition drives most of the burn in technology businesses. So in the above example, for the B2B SaaS company, every time we acquire a new customer, we lose $3,209 in the first month. So businesses that have been burning a lot to grow a lot, you should consider cutting marketing costs way back as a percent of sales. So you may grow more slowly or not at all, but if you can get to break even, you control your own destiny. So let me talk about sort of a B2B SaaS company and what cutting back could look like and how it really would impact the burn. And before I do that, I just want to say one thing. If you're finding this content valuable, please subscribe to my channel right now and like this video. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. Okay, so let's jump into this B2B SaaS company. So Scenario A is in growth mode. So focused on heavy customer acquisition, heavy burn. And this is when the economic and fundraising conditions are very strong. So CAC is $3,500. This is the data just from the business above. So let's say in a typical month, we spend $400,000 on marketing. And so that means that $400,000 divided by $3,500 CAC is 114 new customers acquired. And so our new revenue is basically the $399 times 114. So the new revenue is about $45,000, and let's say we have about $250,000 a month of recurring revenue. So the COGS represent our gross profit margin of 73%. So on that $295 in revenue, we generate $215 of gross profit. Let's say payroll is $250,000 a month. Here's all of our sales and marketing from up above, and then we have other miscellaneous expenses. And so our total OPEX is $750K. So in this scenario, we burned about $535,000, and $400,000 of that $534,000 was all focused around customer acquisition for new customers. So this is a big target for us. So let's say the same company is responding to the current sort of uncertainty on the horizon. They say, we're going to trim our sales and marketing way back. We're a B2B company, so we have a tremendous amount of recurring revenue. We're just going to pull back the sales and marketing. So let's say CAC stays the same, but they pulled their sales and marketing back to $50,000 a month in spend rather than $400,000. Okay, so in this scenario, they only are able to acquire 14 customers. Recurring revenue is the same in both scenarios because these are customers that we acquired previously. The new revenue is down to only $5,500, and so your total revenue is $255,000. Your gross profit is just a little bit less, but same gross margin, so $186,000. Let's say your payroll is $250,000 a month, but now your sales and marketing is much lower. So you have the exact same business, just less customer acquisition, and you have just reduced your burn by about 60%, and you have more than doubled your runway. So, if you're in a position where you had, let's say, 10 months of runway, maybe now you have 25 months of runway. And so this is the thing that you want to optimize your business for right now. So if you have high recurring revenue, I would encourage you to start optimizing your business for longer runway for the time being. And this is without, cutting any payroll, optimizing your gross margin or anything like that. And we're about to talk about that. So this is the type of analysis you should be doing right now. One thing I just want to say is that your burn rate and your runway calculations, take your financial model right now, your projections, and you can just throw it in the trash for a minute. They are totally irrelevant because the forward-looking environment is more uncertain right now. So assume your revenue will just be flat for now, and just look at last month's burn and look at your cash balance and use that as your runway. So last month's burn for the business in growth mode was $534,000. Let's say we have $5.25 million in the bank. So your runway is 5.25 divided by 534. It's 10 months. And so if you can lower it to 213, your runway goes to 25 months. So a lot of businesses will project forward like rapidly increasing revenue, increasing gross margin, and they will over project their runway. So you should just assume that last month's burn is your burn going forward, and use that as your runway for now. The fourth thing I recommend are, considering doing layoffs, and this is for businesses that really need to reduce their burn. So layoffs are very, very painful to do, but they are necessary to survive. You don't want to do these twice, so it's better to do a very large one if you're going to do one. So often companies are able to hire back employees down the line or get an exit for them. I worked at a company that actually had to lay off a lot of employees and later got an exit. So a lot of those employees did exercise their stock options, and so they were able to get a good economic outcome even for the employees that left down the line because the company survived. And the company would not have survived without doing the layoff. And so you really need to think about how the company can survive right now. I heard Charlie Munger say something, which is that he'd never seen a reduction in force where the company wasn't more successful afterwards. And so, like I said, these things are really painful. but generally the company will be in good shape after you do it, and much more lean, much more nimble. And so you want to do these when you need to do them. Also, you can consider temporary pay cuts for highly compensated executives if you have them, just sort of in solidarity and to just reduce your burn until you get more clarity on sort of what's happening next. And so, yeah, the incentives have totally changed. Capital is now scarce. We were in this boom period, and now capital is going to become scarce. We don't know when the capital is going to become available again. Could be soon, could be in a couple years. So we want to get prepared for the worst of the sort of possible outcomes. So number 5 is, although if you are burning money or you're nervous, you probably want to do some kind of reduction in force. For the employees that you are able to keep on, there's an amazing trick to reprice employee stock options with a new 409A if you raised at a high valuation. So let me explain the mechanics of this so you can sort of understand what I'm talking about, the difference between preferred and common stock, and sort of how this can, when you need to do this. So a 409A is basically a report done by an outside firm that assigns a price to employee stock options. And the reason is because it's basically compensation. And so the government wants to keep track of it. And if the company is acquired, there needs to be some sort of base price of the option so that the acquisition price minus the option price is what the employee basically gets. And so an outside firm needs to do this basically analysis. And so you contract them once a year and they price the stock options. So if you raised money in 2021 at a very high valuation, the stock option prices could also be relatively high. So if the investor paid $10 a share to buy the preferred stock, employees have common stock options and investors have preferred. Preferred has a lot more rights. So the common stock options, because they have no voting rights and they're at the back of the liquidity preference, they'll always be lower than the preferred. So it might be, let's say, $3 or $4. The issue is that if your valuations are collapsing, let's say 75%, now the employee stock options could be underwater. So let's say now your business can only raise, money at a $3 per share preferred. So the employee stock option is priced at $3, and now your valuation is at $3. That means your options are basically worthless because the options are only worth the valuation, how much it's in excess of the option price. So the options may have no value or be totally underwater. So what you can do is the board can vote to reprice a 409A in like sort of one-off situations where there's an extreme dislocation or the business itself has suffered in some way. And the firm can come back in and reprice the stock options, even if they were issued sort of in the past. And so they could reprice them, and it's very likely that they would price them at maybe, say, 50 cents or $1. And so you can actually get your employees back into the green, even if your valuation has dropped, by repricing the option. So think about doing this. It's a great thing to keep your employees incentivized and to keep them coming in and working hard during a hard environment. Number 6, the sixth thing you should do is go through everything else in your OPEX and cut things aggressively. So some tips: renegotiate with all your vendors. So enterprise software, contractors, accountants, anyone who you're paying money to, and let them know times are tough and you're going to need a new rate or you'll have to cut them. And ask them to work with you and say that, when times are good again, we want to sort of reset the relationship, but right now we need you to work with us. Most people will actually negotiate with you and lower their rates. And so you can do this, and you should do this with every vendor that you have. Also, eliminate anything that's unnecessary for the time being: travel and entertainment, unused subscriptions, whatever it is. Just clamp down, at least for now, until we can figure out what's going to happen next. The 7th thing is that if you've raised outside money, then you should be working very closely with your investors, managing through this. Let them know your plans. Be very upfront about existential risks and ask them to help. Work closely with your board. Show them you are aggressive and managing cash for a winning outcome. And then if they know you're optimizing for cash flow over growth, they may be more comfortable backing your company again. So deals are getting done. Just far fewer deals. So you want to bring your investors in really close right now and show them that you are managing for the win, and they will be more likely to probably come in and back your company again than maybe a brand new investor. Okay, so I hope this gives you some perspective on how to prepare your business for economic downturns. By the way, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. And as always, in the description below, you can download this Excel file completely for free. And if you found this content valuable, please like and subscribe. Only 10% of my viewers subscribe. Thanks for watching, and I'll see you in the next video.